Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Taiping Insurance Holdings Company Limited annual report. China Taiping Insurance Holdings Company Limited offers a diverse range of businesses and services across various segments. The company's life insurance business segment provides life insurance products such as corporate and personal retirement insurance, group life insurance, individual insurance, health insurance, accident insurance, and annuities. In addition to life insurance, the property and casualty insurance segment offers property and casualty insurance products including compulsory motor insurance, liability insurance, credit insurance, guarantee insurance, short-term accident and health insurance, as well as related reinsurance products. The reinsurance segment provides various types of reinsurance products such as property damage, life, marine cargo and hull, and miscellaneous non-marine reinsurance. Beyond its core insurance business, China Taiping also engages in asset management, insurance intermediary services, financial leasing, property investment, securities dealing and broking, and elderly care investment. The company manages investment funds and provides back-to-back financing arrangements, as well as insurance broking and agency services. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of various factors. On the growth side, insurance service results and net investment results have been significant contributors to revenue growth, with increases ranging from 3.1% to 387.8%. The comprehensive synergy and strategic cooperation business has also generated substantial revenue, particularly from large clients in Hong Kong. New business value and other experience variance and exchange rate impacts have further contributed to revenue growth. In terms of specific business segments, life insurance has seen a 0.6% increase in PRC domestic revenue, while property and casualty insurance has experienced significant growth, with motor insurance up by 2.1% and non-motor insurance increasing by 6.3%. Geographically, the PRC domestic property insurance market has been a key driver of growth, generating $64,282,345 in revenue. Overseas property insurance revenue has also increased, reaching $34,175,541. On the decline side, decreases in insurance revenue have been observed across various regions and business segments. Specifically, CTPI, HK, TP Macau, and TP UK have all experienced declines in insurance revenue, ranging from 0.8% to 10.9%. These factors highlight the importance of regional and segment-specific analysis when evaluating revenue growth or decline. Net income for the company experienced significant growth, increasing by 251.4%. This substantial rise was also reflected in the net income figure, which reached HK $52.972 billion, a 5.2% increase from the previous year. Furthermore, when compared to the preceding year, net income saw an even more impressive surge of 15%. The profit margins of the company also underwent notable improvements. The profit margin reached its highest level in recent years, demonstrating a substantial increase. Specifically, the life insurance business saw a 1.8% improvement in profit margins. Additionally, the combined ratio of 96.5% indicates good underwriting profitability. A significant factor contributing to this improvement was the reduction in reinsurance premiums paid and increased recoveries from reinsurers, which led to an additional 2.5 percentage point increase in profit margins. The overall trend suggests that both net income and profit margins experienced substantial growth, driven by various factors including improved underwriting profitability and reduced allocation of reinsurance premiums. The company's operating cash flow is a mixed bag. On one hand, various reports indicate that it is generating significant amounts of positive operating cash flow, with figures ranging from $109 million to over $2 billion. These numbers suggest that the company is able to generate substantial cash from its operations, which can be used for investments, debt repayment, and other business needs. However, there are also instances where the company's operating cash flow is negative or unclear. Some reports show net operating cash flows in the red, while others indicate operating activities resulting in losses. These discrepancies suggest that the company may not always be able to generate positive cash from its operations, at least not consistently across all periods. Despite these inconsistencies, it appears that the company does have some years and periods where it is generating significant amounts of positive operating cash flow. This suggests that the company has the potential to produce strong cash flows in certain circumstances, but may struggle with this in others. The company's debt level and interest expenses have undergone significant changes. Initially, total debt increased from $496,817,144 to $2,424,248,220, indicating a substantial rise of $1,927,431,076. This increase is attributed to the growth in bank borrowings, which rose from $17,579,251 to $72,378,079. Furthermore, interest-bearing notes also experienced fluctuations, but ultimately increased. In terms of interest expenses, there are mixed trends across different categories. Interest on securities sold under repurchase agreements increased from $806,295 to $1,085,124, while interest on bank borrowings initially decreased before increasing again. However, overall interest expenses have risen, with a notable increase in interest on securities sold under repurchase agreements. The company's financial performance varied across different regions and segments. On the positive side, the Asia-Pacific region, Hong Kong, and China market showed strong growth, with the Asian countries also contributing to the overall success. The life insurance segment and other core operations such as property and casualty insurance, reinsurance, and pension performed well. In addition, overseas life insurance and PRC domestic property insurance were notable performers. On the other hand, certain segments struggled. The reinsurance business in the Asia-Pacific region had a limited scale, implying moderate performance. Overseas property insurance and reinsurance business also underperformed. Furthermore, PRC domestic casualty insurance was another poorly performing segment. Management is focused on a balanced approach that combines progress with stability. To achieve this, they are pursuing a high-quality development strategy in reinsurance business while maintaining a value-oriented approach to seize market opportunities and improve underwriting profitability. The company is also strengthening its ecosystem through new policy premiums, enhanced operational quality, and fintech cooperation. Additionally, management is enhancing risk management capabilities and leveraging the Hong Kong headquarters to support development in the Guangdong-Hong Kong-Macau Greater Bay Area. In terms of investment strategy, management aims to achieve steady progress with higher yields while adhering to a long-term investment philosophy. They are actively seeking longer-dated fixed-rate debt investments and diversifying investments to minimize exposure to market fluctuations. To manage financial risks, management is maintaining a comfortable liquidity cushion and implementing policies to ensure the company can meet its financial obligations. They are also optimizing asset allocation and asset liability management by disposing of non-core assets to improve financial performance. The company has a comprehensive risk management system in place, with risk capital as its core. Management is continuously improving risk appetite indicator systems and strengthening risk monitoring and early warning capabilities to prevent risk contagion. Overall, the company's strategy is centered around stability, progress, and sustainable development. The company's financial activities have been marked by significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has acquired new financial assets worth $29,350 in 2025 and a substantial $324,901 in 2024. On the other hand, the company has also engaged in divestitures, which involve derecognizing or writing off certain financial assets. The most notable divestiture was in 2024, where the company wrote off financial assets worth $3,958,730 and another $4,006,082. These transactions reflect the company's efforts to manage its financial portfolio and optimize its investments. The company's financial activities have been documented in various sections of the report. One notable aspect is its dividend payment history. According to the report, the company has indeed paid dividends, with specific references made on pages 90 and 209. This indicates a commitment to returning value to shareholders through regular distributions. In contrast, there is no information provided regarding share buybacks. The absence of any mention or data suggests that this aspect of shareholder return is not a priority for the company at present. Concerns about inventory buildup and supply chain disruption. There is a growing concern among businesses and experts regarding the potential for inventory buildup. This issue has been highlighted in various reports and studies, with specific mentions on pages 161, 165, and 199. The accumulation of excess inventory can lead to significant financial losses, reduced efficiency, and decreased competitiveness. The root causes of inventory buildup are often linked to supply chain disruptions, which can be triggered by a range of factors including production delays, transportation issues, or changes in consumer demand. When these disruptions occur, businesses may struggle to manage their inventory levels effectively, leading to an accumulation of excess stock. To mitigate the risks associated with inventory buildup and supply chain disruption, companies must adopt proactive strategies that enable them to respond quickly to changing market conditions. This includes investing in advanced logistics and supply chain management systems, building strong relationships with suppliers and partners, and maintaining a flexible and adaptable business model. That concludes the financial summary for China Taiping Insurance Holdings Company Limited. Feel free to comment below, and I will be happy to answer them when possible.